Hey everyone, if you've been keeping an eye on the stock market over the past 6 months, you already know it's been a roller coaster. Tech-heavy stocks, particularly in the software space, have been hit pretty hard. But today we're going to focus on an ETF that has really held up during all this volatility, the Schwab U.S. Dividend Equity ETF, or SCHD. So in this video, we'll break down SCHD's recent performance, why diversification is critical, what the upcoming 2026 reconstitution might look like, and why I believe SCHD could be a strong buy right now. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Looking at the last 6 months, the stock market has experienced a lot of ups and downs. Certain sectors, especially software and high-growth tech, have struggled. But SCHD, it's up about 12% year-to-date, which is impressive given how rough the market has been. Compare that to some other popular ETFs like SMH, which is still only up around 2% for the year, or software-heavy ETFs like IGV, which is down about 14%. SCHD has easily outpaced those, and that's okay because we have to look at the bigger picture. For investors who are patient and long-term oriented, SCHD serves as a stabilizer. While mega-cap growth stocks have mostly stagnated in the last 6 months, SCHD has quietly carried portfolios through the storm. It's one of those ETFs that keeps your overall allocation from being too exposed to the ups and downs of a single sector. Even on a year-to-date basis, while the S&P 500 has dipped into negative territory, SCHD has still managed a 12% gain. That's not something to ignore, especially when you're trying to manage risk and still participate in growth opportunities. Diversification is a word you've probably heard a million times, but it's worth emphasizing. Let's rewind to 2022 as an example. During that period, the market faced prolonged downward pressure. The S&P 500 ended the year down almost 20%. Now, if you were heavily invested in big growth names like Nvidia, CrowdStrike, or Tesla, you probably saw losses ranging from 50% to 65%. For many investors, seeing a portfolio drop that much can be a psychological trigger to sell at the worst possible moment. And unfortunately, a lot of people did. A lot of SCHD, however, provides balance. In 2022, it was almost flat, down just a few percentage points, even during that market downturn. That allowed investors to remain patient with their high-growth positions. If you believed in companies like Nvidia or Tesla, SCHD essentially gave you breathing room. You could weather the storm instead of panicking and selling at the bottom. This is the beauty of combining stability with growth. SCHD may not have the explosive returns of a hot tech stock, but it's consistent, reliable, and it allows you to take a longer-term view on more volatile holdings. Now, let's talk about something that's coming up, SCHD's annual reconstitution. For those unfamiliar, reconstitution is when the ETF updates its holdings based on a set methodology. SCHD isn't picking stocks at random. It follows an algorithm that focuses on quality, considering metrics like dividend yield, dividend growth, free cash flow, and free cash flow to debt ratios. Currently, energy is the largest sector in SCHD, representing about 21% of the portfolio. Consumer staples are next at 17%, healthcare at 16%, industrials at 11%, and consumer discretionary at nearly 10%. However, all of this is about to shift, and I believe the changes will be positive for investors. Last year, the reconstitution was heavily focused on the energy sector, which wasn't particularly exciting. Sure, energy prices had spiked due to global events, but those gains are often short-lived. Taking profits in sectors like energy when possible can be a smart move, and SCHD's methodology often aligns with that philosophy. One thing I really appreciate about SCHD is its disciplined, quantitative approach. The ETF isn't run by humans making emotional decisions. It's a rules-based system. It identifies the top 100 companies that meet its criteria for quality and dividend stability. If you're curious, Seeking Alpha Contributor. The Sunday Investor created a model that emulates SCHD's process. It shows how the fund whittles thousands of potential stocks down to the top 100, focusing on strong fundamentals and consistent dividend growth. With the upcoming reconstitution, we're expecting some noticeable changes. The energy sector is projected to drop from 20% down to around 12%, which I love. Consumer staples will take the lead at 20%, followed by healthcare at 18%. Financials will see a jump to nearly 15%, while technology will remain relatively stable. From my perspective, this is an excellent mix. You have defensive sectors like staples and healthcare to protect the portfolio during downturns. And you still have financials and industrials to capture upside if the economy continues to grow. It's also worth comparing SCHD to other dividend ETFs. VIG and DGRO focus heavily on dividend growth, but they tend to have higher exposure to tech. That can mean more volatility. On the other hand, HDV and VYM emphasize high yields, but SCHD manages to deliver a higher yield than both of them while maintaining faster dividend growth. It really is the best of both worlds: solid yield, consistent growth, and a rules-based approach to quality. SCHD has proven itself over the long term, making it a reliable core holding in a diversified portfolio. Currently, SCHD offers a yield of around 3.5%, a 5-year dividend growth rate near 10%, and an impressive streak of 14 consecutive years of dividend growth. That kind of track record isn't something you see in every ETF. For those curious about the specific companies in SCHD, the top holdings include names like Lockheed Martin, ConocoPhillips, Verizon, Chevron, Bristol-Myers, and Merck. These are large-cap, high-quality companies with consistent earnings and strong dividends. They're the kind of stocks that form a reliable foundation in any portfolio. Looking forward to 2026, the sector mix is shaping up nicely. Defensive sectors like healthcare and consumer staples dominate the top spots, which provides safety if the economy slows. At the same time, financials and industrials are positioned to benefit from ongoing economic growth. This balanced approach gives SCHD a best-of-both-worlds profile: offensive exposure to growth sectors and defensive positioning for market downturns. That's why I think SCHD could be poised for a strong year ahead. So why am I bullish on SCHD heading into the reconstitution? First, its track record speaks for itself: strong dividends, consistent growth, and resilience during market downturns. Second, the upcoming changes seem to improve diversification further, with less concentration in energy and more emphasis on staples, healthcare, and financials. Lastly, compared to other dividend-focused ETFs, SCHD really stands out. It's yielding more than other high-yield ETFs, growing dividends faster than dividend growth-focused ETFs, and maintaining a quality-focused methodology. That combination makes it a compelling buy for long-term investors. To summarize, SCHD has been a stabilizer during recent market volatility, outperforming many tech-heavy ETFs. Diversification is key. Having SCHD in your portfolio allows you to be patient with higher-risk growth stocks. The upcoming 2026 reconstitution will likely improve sector balance, reducing energy exposure and increasing defensive and financial sectors. SCHD offers both yield and growth, outperforming other dividend ETFs in key metrics. Its top holdings are high-quality blue-chip companies with long-term dividend growth. In short, if you're looking for an ETF that can provide stability, consistent income, and a well-rounded sector mix, SCHD is a strong contender. Heading into 2026, I'm confident it could be a top pick for investors seeking both safety and growth. All right, that's it for today's deep dive into SCHD. I hope this gave you a better understanding of how this ETF works, why diversification matters, and why the 2026 reconstitution could make it even more appealing. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.